So hello, welcome back. So this is the series of macroeconomics for beginners and social impact. Now this is module 3. In this we're going to be discussing national income. So let's see what we have done. We'll do a quick recap. So what is macroeconomics? What we did is we learned what is macroeconomics. We did model building, we saw demand and supply equilibrium, and we'll have more numericals coming up on this. We'll have a bit of applied economics also coming now. We have behavior of prices in short term and concept of markets. We also came to know the concept of market clearing. Look at what we did in the second module, which we learned about GDP, what its components are. We took an example of United States of America. We also took a bit of other examples. We try to understand what makes GDP, and GDP is one of the most important factors when you're looking at right now when we are looking in economics. We learned a bit about real GDP versus nominal GDP. We learned about inflation simplified, both consumer price index and GDP deflator. We also learned a bit about GNI. So just a quick recap of what we did. Give you a fair idea of what real versus normal GDP is. So I took, since 1929, I took the data. I mapped it. I saw what the real GDP growth was, what was the real GDP versus the normal GDP. Now we know real GDP is normal GDP minus inflation. So to filter out inflation or price effects, we calculate the real GDP. So whenever I'm talking about GDP, going forward, like we discussed, it will always be real GDP. So we have seen, like, out here how the crisis was, what happens to a GDP. So when we're talking about a recession might not be 2 quarters. Basically, it's 2 quarters. It need not be consecutive quarters. It has 2 quarters in a year of negative growth, GDP growth. Depression, when you're talking about, is it's a recession for a very longer duration. Now the data which I've used, now this is growth versus GDP. Now the reason why I have used here a bit of inflation. Now when we look basically the Fed fund rates, I want to highlight how the monetary easing takes place. So going forward, we look at it. I just wanted to introduce the concept. We see always the central bank rates are cut when there is a recessionary conditions, right? So this is, and when inflation is very high, we see a rise in the GDP. Now this is a very, when there was a lot of inflation. This is the time during the early 70s and late 70s when there was an oil shock. Now because of that oil shock, we had high inflation in the US. During that period of time, you see there was the Fed fund rate was at its peak. So just to give an example how the Fed fund rates moves along with the when we're talking about fund rates, how it moves along with, have it for a very long period of time. So I've taken the data from 1930 to 2002 till the present time. So to just give you a very good picture of how the economy has moved in the US. Going to be ahead. So in this part, when I've talked about what are we going to be discussing in this series. Now this series has begun. What we're going to be discussing today is like classical theory in the long term. We're going to be talking about national income and factors of production. Now this is going to go on. We'll see an overview of quantitative theory of money. So this is going to be 2-3 modules on this. We'll take separately the overview of labor market. Today talking about business cycle theory, the economy in the short term, and growth theory, which is economy in the long term. Just to give you a fair idea what we're going to be saying now, in the long run we'll see that GDP depends upon supply of goods and services. So this is something which is not very evident, but as we go along and we learn, in the long run the GDP is totally dependent on supply of goods and services, where in the short term we talk about aggregate demand, which is an influencer. Now we have seen that prices are sticky in the short period of time. We saw that in the first presentation, that prices don't move even if the demands fall. So one of the major determinants of short-term aggregate demand. So when I'm talking about aggregate demand, I'm talking the whole demand of a economy. So it moves upon monetary policy. It depends upon fiscal policy and shocks to the economy. So this is a good example of what we are talking about here today. And the long run, we see that inflation is totally dependent on growth in the money supply. So now what we see is what is the role of policymakers. So that's why does when we talk about macroeconomics, why it's very important. So it's one of the biggest determinants for policymakers, in the sense we look at GDP. Policymakers always look at GDP, inflation, and unemployment rate. These are what basically central banks very closely look at. The whole world also closely looks at. Then, and one of the aggregates, sort of in a short term, we looked at for aggregate demand, monetary policy, fiscal policy, and shocks to money and goods market. national income. We looked at three variables. So we looked at right now we'll be talking about three because we're talking about a closed economy. So we know output is fixed. We know it's driven by consumption, investment, government purchases, and net exports. Net exports is imports minus exports. So this is in the last module we had a detailed look. We'll also look at some of the numericals going forward. So a lot of worksheet problems are going to be coming this week. What we're going to be doing in this module, we'll understand national income and savings and the relation. We'll see how the demand and supply comes into an equilibrium. We saw that in the first, and now we're going to be again seeing, we are here going to come to a concept of loanable funds, demand and supply loanable funds, and we'll also have fiscal policy determinants and its social impact. So we'll have a fair idea how, when we talk about monetary policy, when we talk about fiscal policy, we talk about so much of social impact. We the flow of money through the economy. Now this chart we are going to come back because as we go forward, you will have a fair understanding when I'm talking about private savings, I'm talking about public savings, I'm talking about factor payments. So let's come to this at the end of this presentation. Now we talked about determinants of total production of goods and services. So this is a very important concept. We'll not go deep in this, but we'll just touch upon it. So what are these factors? When you're talking about factor payments, is basically quantity of inputs. So when we are talking about production, we are talking about two factors which are constant. We're talking about capital and labor. So that's why I've put this sign means that the labor is fixed and the capital is fixed. Let's talk about what is factors of production. Now these both capital and labor is what a firm would employ, and the output is given through a technology. So you have productivity, and productivity depends on the available technology. So the factor, the production function is y is equal to function of capital and labor. Now this is very important at this point of time. So what we have learned is very simple. There are two factor payments, quantity of inputs, factors of production. One is capital, one is labor. Both are fixed in an economy, and the function of productivity is basically the relevant technology, available technology, which is driving these two functions. So now let's look at labor prices and factors of production. This is distribution of national income. So now we come to factor prices and production. So let's understand in the short term with this diagram, we'll try to understand how the factor price and the quantity of factor demanded moves. Now we see a price and quantity equilibrium. We saw a diagram where the price and quantity move. So as the quantity demanded moves inversely proportional to the price of the product. Now in this case, you have taken quantity as a quantity of the factor in the x-axis and the factor price in the y-axis. Now we know the supply is fixed. So the factor curve is going to be absolutely vertical to factor price. Now take for example, whatever be the factor price, what it means is the supply curve is going to remain fixed. Now we know that the quantity of the factor is inversely going to move dependent on the factor price, which means this is the point of equilibrium where the quantity of factor demanded would decrease as the price. So at this particular price, the demand is going to match. So this will be the equilibrium price. From here, from the production function and from how the economy moves, we know for a fact the production of an economy has two variables, two inputs, which you are taking like quantity of factor. So there are two factor inputs. One is capital, and the other is labor. So sorry, the labor, means the employee is working for an economy. So it's just termed as labor. So everybody is included labor. Now these two are fixed. The supply curve is fixed. It's not going to vary. When there is an increase, let's say if we take this as a factor payment for labor, let's say when the price of the labor is going to move up, as the price of the labor is going to move up, what's going to happen? We'll have a new inflection. Let's say if there is a lot of demand, and we are seeing this as a demand curve, and this is the supply curve. Now we call this as a factor demand. If the factor demand goes up, we are going to have a new equilibrium point, which basically means the equilibrium price has increased. However, that is not going to affect the supply curve at the short. So we are now talking about an economy where the supply curve is constant. And understand how the things are going to be moved. Now we know that when we are trying to see a demand in an economy, we know nx is going to be 0. We are considering an economy just for the simplicity. We'll also come to an open economy, but for this example, we are taking the case of a closed. We are focusing on demand in a closed economy. Now we know the four functions. We know in a closed economy nx is 0, there's no export import. For simplicity, we're starting with the closed economy. We'll also come to an open economy. Now we know the consumption is a factor of disposable income. Now the economy goes through a taxation. So because of this taxation, you ultimately have a disposable income, which is basically the output we know is fixed, is y. You tax, and y minus t is the taxation income. There is also a component known as propensity to consume. This is basically which means that if how much are you going to be consuming for 1 unit of increase in your paycheck. It could be $1 of increase in paycheck, it could be 1 rupee, 1 euro, or whichever currency you're talking about. So private savings would be y minus t minus c, which is basically the output minus the tax minus the consumption. So this would give you ultimately private savings. Let's take, now when we are looking at C, we know C is going to move between 0 and 1. So it's a sort of a proportion. For example, if I'm earning $2 extra, how much am I going to be consuming? So that depends on the propensity to consume. So this is a very simple concept. So we talked about propensity to consume. It's a amount for which consumption increases when disposable income grows by 1 unit of currency. It could be whatever one unit which you are taking as fixed. It's basically a fraction between 0 and 1, which we discussed. Now we talk about investment and real interest rate. So this is very important. So when we talk about quantity of investment goods demanded, when you're trying to invest, what does it depend on? It depends on the interest rate, which actually is nothing but the measure of cost of funds used to finance investment. Now interest rates measure the cost of funds used to finance an investment. So whenever we're talking about interest rates, usually it means nominal interest rates, but what we should be looking at is real interest rate. So real interest is nothing but nominal interest rates minus inflation rate. With this, we come to a concept known as Fisher equation. Now, real interest rate, basically it's nothing but nominal interest rate. So it's real interest rate plus inflation. So which is nothing but nominal rates. So nominal interest rate is equal to real interest rate minus inflation, which is the Fisher equation. Quantity of investment. Now let's say if you're looking at quantity of investment demanded and we make a graph, it's basically as simple as a demand and supply graph. This is a function of interest rate, which is interest rates go, the quantity of investments keep on increasing. The quantity of investment demanded keeps on increasing. Purchases and public saving. We know government purchases, we know governments have tax economies. It could be two types. So taxes are two types. Let's consider here taxes. So one is direct taxes. The other so let's say, and that is defined as T. So when G is greater than T, you get a budget deficit because you're actually funding more. We looked at what is government purchases. Government purchases means anything which is purchased for defense. It could be for healthcare. We are not, of course, we did see that, transfer payments are not a part of the GDP. However, for example, a lot of money does go into social security, although it does not contribute towards the GDP. However, government does pay towards it. So when you're talking about government purchases, when the spending is more than the taxation which the government is going to raise, then you have a budget deficit. If the taxes are lower, if the government purchases are lower, then you have a budget surplus. What is national savings? We saw plus government purchases. We know is equal to 0, so we will not bring that. So ultimately y minus c minus g. Now I is nothing but the investment. Also it's known as national savings. Basically, if you have an output which you earn minus the consumption minus the government purchases will give you the net investment. It also gives you the net saving, which is what. So when you're talking about national savings, this equation can again be written as y minus tax minus g, because we saw this is known as private saving. Y minus t minus c, t is where the tax minus the consumption. We looked at something known as propensity to consume, consumption factor. However, right now we are simplifying it. Since I've added t here, I have to add subtracted t, I have to add t, which is nothing but t. This equation can be written as y minus t minus c, which is private savings, plus t minus g, which is public savings. So this becomes an overall equation, and this is known as, so national savings now we know is composed of private savings and public savings. So now we will have a much better understanding here. So let's go from here. Now we know households pay taxes. It goes as a private savings. Whatever households private savings, it goes into financial markets. You can make a deposit to a bank, you make a checking account, especially the deposits. Now these deposits then have a multiplier effect. We'll see this going forward, what I mean here. But for right now, we'll just presume that the financial markets take these deposits and then they further out lend. So this lending goes into the markets of goods and purchases. The other taxes is what the government collects, and government also does government purchases in the market for goods and services. Now, these firms, when they basically have a revenue, this revenue becomes a factor payment which we discussed for either the as a rent capital or as wages for labor. So labors are paid what we know as wages, and the capital has got a rent value, which these two are the factor payments which go into the market for an economy. Now this becomes an income for the households, right? So if you look at these households, what they consume, whenever they want to consume, what they pay is taxes, is what goes to the government. The private savings go to the financial markets, and they consume in markets for goods and services, which becomes a revenue which goes back to the firm. So when we look at here, we see the expenditure which is happening from the household part. We know households are doing three things. They're consuming. It becomes basically the revenue for the firms or whatever goods and services they take. They are taxed by the government. So this government taxation again goes to government purchases, which we see here. Otherwise, they put their savings into financial markets. These financial markets become another way of then come back. The savings come back into the market for goods and services. Now, so let's look at this again. Households, let's say that household is this. We start at one node. They consume. They buy goods and services. This becomes a firm revenue. The firms then, in order pay the for the capital, which we saw, there are two types of payments here. Capital, basically the rent they pay, which is known as rent, and for labor. So we are now considering these two as the factor payments. They go into the economy. This is basically becomes the income for households. Now, from the other is the taxes. The government gets the taxes. It purchases. It goes to the market and purchases various services. That itself becomes the firm revenue and comes, and this again goes back into the economy. The other way is that household, which is known as the public saving, and from government, which is known as the from household, which is known as the private saving, and from government, which is the public saving, is invested in financial markets. So when we're talking about financial markets, we're talking the whole financial markets only, which includes bank, asset managers, but predominantly when you're talking about here is banks, and this becomes a way of payment for market for goods and services. So this is the whole chain. So we come to know here that expenditure we see nothing but equal to income of an economy. So now we know the circular flow of money, how it moves through the economy. So you have a fair idea of how the economy moves. This is just to give you a sort of chart. We wanted to see how inflation, growth rate has changed between France, Sweden, and India. We see in an emerging market grows more, but then it also has high inflation. So just we look at when the GDP was growing higher, maybe the inflation was higher, just to give you one fair example. Now coming up, we'll see we today understood the concept of interest rates, what is real interest rate, and that is what we are going to be applying to supply of loanable funds and worksheet problems. So we'll go forward, we'll look at these two problems. Now in this week we'll have a lot of worksheet problems, so we'll have a few problems coming in right from chapter 1, module 1, module 2, module 3.